As a non-resident, when you acquire shares of an Indian company from the sellers, you may also want to infuse certain funds directly into the company. And when you do this by way of equity shares, there is this provision which is different from most part of the world that you need to be aware of. For this provision, typically referred to as Section 56 to 7B, what you need to be aware of is you need to calculate the fair market value of the Indian company. Now, this fair market value has to be calculated under different methods which are prescribed. And in certain cases, there are also safe harbor provision where a difference of 10% is something which is acceptable. But if you are infusing the money into the Indian company at above the fair market value, then the Indian company is supposed to pay tax on the difference between the fair market value and the price at which you infuse the equity shares and pay tax on that as income from other sources. That may be taxable in the hands of the Indian company at 22, 25, or 30%. The reverse of this is that if you infuse the money at a discount, in that case, the difference between the fair market value and the discounted value, or basically the discount portion, that can be taxed in your hands as income. So whenever you want to acquire a company or you want to do a primary infusion, these 2 points, which we have worked around with the various clients, is something that you have to be aware of. And you should carry out this exercise because otherwise this can actually result in a lot of taxation in your hands or in the hands of the company which is raising money from your end.